Right, so I think we're all now sat down for the rest of the panel session, and we're moving around. We've got a half an hour or so for you to ask questions of the panel. The theme is obviously financing market in the region. Just to give you a bit more background on each of the speakers so you can direct questions accordingly. So we have Mark on my right who, as well as having a lot of experience and knowledge of the streaming sector, worked initially for IDC in South Africa, was then the head of Nedbank's financing team here based in London, now has a financial advisory house, Bardeen Financial, and separately works for a metals business at Aramet. So a range of experience in the sector. Ayuna, as you know, is one of the senior principals at the London Stock Exchange. We have Ignacio, who is the Chief Investment Officer for the Natural Resources team at the IFC, one of the largest development finance institutions around the world. We have Ingo, who's head of the mining and metals team at Hannam Partners, a merchant bank providing advisory and structuring services and merchant banking services generally across the sector in a range of jurisdictions, but with a strong focus on this region in particular. And then we have Stephen, who you probably hopefully listened to his presentation this morning, heard that he started out his career with Mark Rich and now has his own commodities business, Talex Commodities. So you've got a range of speakers from different financing backgrounds who have experience across the region. I think as a good opener, I'd just like to ask a question of the panel before we open any questions up to the audience. And it's a very broad question, so it's up to you each as to how you answer it. But what do you think is currently the financing environment like for projects in Central Asia? Do you think it's any better or worse than it has been in recent times? Do you think it's on a good trajectory? Can I put that question first of all to Stephen?
In terms of I think over the last few years, I spent the first 20 years of my career working in Central Asia and the former Soviet Union, and I moved away from doing that region primarily because it just became increasingly more difficult to actually close transactions. And then one is quite opportunistic, and I started focusing more on Latin America, which has been very prodigious in terms of deal flow over the last few years. In terms of where Central Asia is going, I think that the perception amongst some investors, especially in North America, they sort of group together Russia with Central Asia, and this is to the detriment of the Central Asian countries because they clump together Russian risk with Kazakh or Mongolian or Tajiki risk, which is not correct. But that is the perception. So I think to answer the question, I think that there is some decoupling going on, and I believe that investors are differentiating because they are looking for those opportunities. And as South America has become much more popular, capital is looking for higher returns. Those higher returns are becoming compressed in markets like Peru and Chile. It's hard to get those returns on capital. So I believe this is to the benefit of Central Asia, where the returns on capital are now coming up and now becoming more competitive for Latin America.
Okay. Ingo, is that consistent with your view?
Yeah, I would slightly differentiate this because I think it's always a question of distance. And if Stephen sees it more from the North American perspective, yes, if we market in the US, I guess there's sort of say a negative spillover effect from sort of Russia to the neighboring countries, but we don't naturally see the same sentiment if you speak to investors out of the Middle East or out of Europe, where there's a much clearer demarcation between the developments south of the border, so to say, than what's happening geopolitically with Russia. But I guess the key point is always, first of all, you can price risk, and there's deposits that are really embarrassment of riches in Central Asia. And the second thing is you need to see it in the context where the commodity markets currently are. And I make a comment first on the later. The markets are actually not bad. I mean, prices are significantly higher. Still, even so, there was a softness from middle of this year, where they were like 3 or 4 years ago. But what really has happened in the financing sector is two things. First of all, people really went back into the market supporting probably electric vehicle battery kind of themes relatively early on last year. And many of these investors see losses, so it has nothing really to do with Central Asia per se, but there is a lot of people out there who have not necessarily made money over the last 12 months. The ECM, the share price performance was not particularly good. And the second thing is that, and Mark is probably a great example of this, if you look back, and this is the same if you go to TSX or the New York Stock Exchange, London, or the ASX, 10 to 15 years ago, 75% of these stock exchanges, if you look at mining stocks, were pretty much owned by long-only kind of active investors in this space, so the Fidelities and Capitals and JPMs and etc. This has completely changed. These are everywhere now less than 50%. There's streaming funds who own equity, there's private equity funds who own equity. There's a lot more ownership if it's like Middle Eastern funds owning big chunks of Glencore and have done so for some time or since the listing. That it's not that straightforward anymore that with one roadshow you basically cover New York or cover New York and London and Hong Kong and then you basically are done. I think there's a lot more creativity necessary, especially to fund junior projects into production.
Yeah, maybe just to bring probably Stephen and Ingo's comments in a way together. I think, like Stephen, if you look at IFC's investment in the region, we were very active in the sort of 2000s, early 2000s. I mean, we got into Kumtor, Centera in Russia with Peter Hambro, with Bima Gold at the time, Kinross, etc., etc. So we were very active. Quite frankly, we have not been as active in the last sort of let's say 10 years or so, and in part because there were limited success stories in terms of at least international, particularly on the junior side, international juniors in that region. And you know, as Stephen says, there were easier pickings in other places. So I think that's a reality. I think linking up to what Ingo says, apart from the Central Asian theme, the financing landscape has changed a lot globally for mining companies, and particularly for junior mining companies over the last sort of 5 years or so. And the complexity of mining financing has increased. If you look at it on the positive side, there are many more sources of financing, and whether it's from Asian sources or even there are even pension fund money. So as IFC, we've raised $7 billion of pension fund money, insurance fund money, AXA, Munich Re, Swiss Re, etc., who are interested in long-dated, high-yielding assets in emerging markets. So something that wasn't necessarily there 5-10 years ago. So that's all very positive. I think where the headache comes is that it's much more complex, and to put together a financing for a mining project, you're going to have to, as you say, you can't just knock on a couple of doors with a PowerPoint presentation and think, I got it. That no longer works. You have to be much more creative. You have to look at the streaming companies. You have to look at the PE funds, the RCFs, the Orions, the Appians, the et cetera, and so I think that's a reality. I think also on the positive in terms of Central Asia, we are, and that's one of the reasons I'm here. We are, as IFC, trying to see, okay, what can we do? There are positive signs in Kazakhstan. There are other countries in the region that are moving in the right direction through privatizations, or at least changes in mining law, and so that's very positive. So hopefully that can bring another wave of investors from at least from the international this side of the globe back into Central Asia.
Ian's commented already, so Mark, anything you'd like to add?
Yeah, I think that's right. I think I agree with Stephen and all of the other speakers that as the commercial banks, from a debt perspective, as the commercial banks have withdrawn from the market, globally, as not only they've withdrawn from the market globally, from the debt market, from the mining market, and there's only a handful of commercial banks that are doing this sort of thing anymore. What's happened then is that the intermediation between investors and the mining companies has changed and has gone into people like the streaming companies, the credit funds. And to a large extent over the last few years, they've built up their portfolios in the countries countries that they were the most comfortable with. And as Stephen said, the returns in those countries are no longer what they used to be when they first started out. So there is an opportunity for Central Asia to tap into those, and I think we will get interest from the companies coming in there immediately.
There have obviously been some big projects there that have been financed. Ignacio, IFC was obviously an important part of the OT project. To what extent do you think that could act as a template for other projects in the region?
Yeah, I mean, I think the OT financing was quite a unique financing. It's approximately $4 billion. IFC, we mobilised approximately $1.2 billion of that financing for Rio in Mongolia. But I do think it's an interesting case study in terms of a major mining development, which is nation-changing in terms of its potential impact on the economy of a country. And seeing how, and a 50-plus year mine life. And I think there it's important, I think it's quite interesting to see how Rio approached this in looking at this as a very long-term partnership and seeing who do we want to bring in as long-term partners for this mine. And it's not just the money. Obviously Rio could have financed that on the balance sheet. Yes, there's an element of de-risking, but it's also an element of partnership. First partnership, obviously, with the Mongolian government and seeing how they could finance that and help the Mongolian government finance their share, but also seeing how can they bring in the World Bank, EBRD, other institutions that can get everybody comfortable around the table that the right things are being done for the country in terms of environmental and social standards, in terms of revenue sharing, et cetera, et cetera. And so I think that's a great example of how to do and how to finance a project. And again, not only because of the money aspect, not only the dollar aspect, there are other aspects in terms of long-term partnerships that are important, as we've seen in Kyrgyzstan and many other countries. You have to get those right, and you have to build that confidence and cooperation day by day. It's not you don't just start producing and that's it. It's 50 years of partnership. So
you mentioned environmental and social briefly there. So have you seen significant E&S trends in the region that you think will have an impact going forward on people's willingness to finance projects there?
Yeah, well, look, I think generally there have been very positive trends from an environmental social perspective in the region. I think many companies have really come up the learning curve in terms of environmental social standards, whether it's abiding by IOC's performance standards, Equator Principles, or others. It doesn't really matter. I think that the point is lots of companies have really espoused these principles. So that's really positive. I think where things are changing or what's interesting now is the whole climate change debate and how that's sort of impacting the mining sector in two aspects. One, in terms of the minerals mined. Ingo made reference to the whole sort of EV EV sort of euphoria, which is very positive, I think. The other thing is, for example, coal, and how where's coal going in terms of a commodity, and what's the appetite of financing institutions such as IFC and others to finance or invest in coal assets. And we've seen a number of instances. X2, the private equity fund, is a relatively public case of disagreements among investors in terms of their appetite to take coal. Sometimes that's for commercial reasons, but also for environmental reasons. Multilateral institutions such as IFC have more and more difficulty in financing coal projects. Actually, frankly, IFC, we don't finance coal projects anymore. But it's not really the finance of the coal project, it's where does the mine get its energy from? And again, that's another area where at least multilateral institutions are looking more and more closely. Well, if it's getting its power from a coal-fired power plant, what are the alternatives? Why aren't they looking at alternatives? And I can go on for hours about some of the things we're doing in terms of battery storage, in terms of small-scale LNG and gas. But I think that's a very interesting area, the climate change area, which is slightly different than 5 years ago.
We'll take some questions, start taking some questions from the audience. Would you like to start?
Thank you. My name is Richard Sheriff. I'm a partner in Strategy Worldwide, which looks at risk and helps clients understand and design strategy to manage risk. So my question for the panel is, and it's picking up concerns from where Ignacio was talking, is as investors and financiers, how do you really assess the risks of a project? How do you assure itself that a project or a company or an organisation has got a properly thought through strategy to manage risk?
Okay, should we start? Steve?
Yeah,
Happy to start.
Yeah, pleasure. I think that's an excellent question. A lot of it is just sort of straight box ticking, in a sense. When you're looking at a project, I mean, the way I look at it, as I look at the quality of the management team, the underlying commodity, the jurisdiction, permitting, just sort of common sense things that you analyze to analyze risk prima facie. And if, for example, it could be the most fantastic project in the world, but if you have a subpar management team, the execution risk on that project is such that it throws it into a very high risk. So, I mean, for me, when I analyze a project, I just sort of go through that. And of course, things like community or First Nation also creates other issues.
Yeah, from our perspective as mostly advisors, we would appreciate often that the investor spent a lot more, and I'm not talking now about large capital markets transactions like, for instance, Kazakh-Comprom, more on project financing deals. But time is short. Investors sit in international concentrated places, and we have, of course, seen often stories where there was very limited on-the-ground due diligence being done, surprisingly little in our view. I guess trading organizations are quite different. That's probably also what you're referring to, where traders often have many offices, they have big networks, they therefore have much better ways to triangulate into certain situations, where financial investors have often much more concentrated teams. And I think many of the issues that funds have seen could have been prevented with more significant, especially on the ground. And it's not just a site visit. I mean, we have had investors really ask us to travel into a country for a week or two, kind of accompanied by the organization that actually tries to sell them the capital, to triangulate in, meet stakeholders at every level, visit the infrastructure pieces and give a more independent view of it. And this often leads to, and this is a question on really true advice, often leads to then also a negative outcome, but that's often then also the right and best outcome, of course.
Yeah, I think on the social political side, again, I said it was more complex on the financing side. It's definitely more complex nowadays in terms of social political side. So, in the old days, you'd go and see the central government, make sure they were okay with the project, and more or less simplifying. I think right now, what you realise is, whether it's through social media or other things, the complexity of stakeholder interactions is unprecedented. And any of those stakeholders could create an issue for your project if you don't understand it and if you don't address it. So whether it's, you go and you talk to the elders of the village and you think you're done. Well, if you haven't spoken to the youth of that village or that group of villages, well, maybe they have a fundamental issue where they're disagreeing with, their older parents or grandparents who are, the mayors or whatever. And if they're the ones who are wanting the jobs and are willing to actually block access to your mine, then you've got an issue. You might have thought it was okay because you spoke to the head man and the mayor and whatever, but actually you haven't done your job. So, and in this day of social media, where in Twitter, young people can just organise a blockade very quickly or do something, you have to spend much more time in understanding the complex interactions within your local community, between local community, regional government, central government, and the factions within central government and the factions within regional government and all that, to understand what's actually going on and where are your true risks.
From the listing perspective, this is actually a question that issuers from emerging markets ask us very often. They ask us, what is there an emerging markets discount? How are we going to be checked on what levels, and how are investors going to measure that risk? And The truth is that a company, before going public, has to go through several stages. And Ingo referred to the due diligence process. That's a given, right, by banks and lawyers and so on. But also there are several layers of risk. So there's a country risk, there is a sector risk, and a company risk. And also, you mentioned management. Yeah, the management needs to be high quality. So by the time a company comes to sort of the actual preparation to going public, they're in a state where they've probably had all of the layers of those risks assessed, and they have the section in the prospectus where they disclose on many pages everything that might happen in the future, so that investors can measure it appropriately and give us appropriate valuation and set the price range. What we find is that a lot of the companies instinctively aim for higher valuation. They want the IPO to be a huge success. They want to get valued at the highest level, with a premium to the market. But what we find is that with over the past few years, and we've had choppy markets over the past few years globally, companies tend to actually price sort of mid-range or low range, and then they trade up if they're a good company. Well, we see that sometimes if a company is valued very high, maybe at a premium, then if they then don't trade well, then it's not such a good story.
Yeah, I think mining is inherently risky, and it's hard to imagine any class of risk that could exist anywhere else that doesn't exist in mining. And I think what happens is that investors make assumptions about how these risks are being evaluated, and whether there's people that have actually had a look at it and are warranting that those risks are not significant anymore. So you find, for instance, investors who rely on the stock exchanges to vet the people that are behind the transaction. And some people would look to some of the stock exchanges to even look at the resource risk to be evaluated. I think the real issue is that many investors make implicit assumptions that are not always valid, and that there isn't the representation, implicit or any other, that this risk hasn't been accounted for. So I think investors do need to spend a bit more time evaluating the complexity of the industry.
Yeah, I mean, I could maybe just comment for a second from a sort of legal diligence perspective. Clients do the same basic legal DD that you would typically expect, and that doesn't change very much from one jurisdiction to the next. Solid license, solid contractual regime, agreements in place that they're stating are in place. But they are, I think, more and more clients are becoming more sophisticated and going further beyond that. The horizon risk when it comes to legal regime in the country is one of the most commonly discussed areas when we're doing diligence with clients. What is the mining code? What's it expected to look like in the next 5 or 10 years, and that's really difficult to discuss. And a lot of it's based on what's happened over the previous few years. Has there been a period of stability as a country that they can perceive, and anticipate how the legal regime is likely to develop? Some of that is an imprecise science, but obviously history is always a good precedent for these things. Okay, next question.
I'm just curious, why all these problems described here, all this risk, they won't stop Chinese investors to work in areas where now European investors are still just thinking about Chinese here already in mining business.
Okay, anyone like to start with that one?
I'm happy to take the first shot.
That's a good question.
It's a really good question. And in Latin America, especially Peru, we come across the Chinese SOEs quite a bit. And they just look at risk in a completely different way than we do. And so they see the SOEs and ultimately Beijing see mining and resources in general as an element of their foreign policy. And often in their underwriting process, they might look at them at a 43-101 or a JORC, but they look at it as, can this fit as an instrument in their foreign policy, especially when it comes to tier 1 assets. So often it's an uncompetitive situation because from a Western perspective, in private equity or whether it's a stream or debt or whatever it is, there's a rigorous underwriting process which looks at the mine plan and ultimately looks at discounted cash flow and the returns on your capital given the jurisdictional risk. And you just can't move away from that formulaic approach. And so the Chinese just don't play by those rules, and therefore they're, especially when it comes to Africa, they look at risk really in a completely different way, and they effectively, especially in certain colonies, they colonize certain countries with total disregard for the financial returns. So that's my
so we obviously have worked for very significant Chinese clients in their outward acquisition endeavors. One thing that, and I had a meeting yesterday afternoon on a very significant transaction, and the representative was not, it was a private organization, multiple dollars of market capitalization, simply said, we have the valuation, that was the business development team, but we have not discussed it with the owners. It's probably very unlikely we will ever discuss it, which simply comes to the point, I think there's not, I wouldn't go as far because they're very successful, obviously, what they're doing, that they have a complete disregard of valuation, but it's a much more top-down organization where the guy at the top built the organization for the last 30 years and simply has a pretty good sense in his mind what the strategic value of this business is. And this is private organizations. I think on the state level, of course, it is really driven by non-financial consideration, which is it started in Angola in oil, and who was here in the morning, we looked at what is a strategic metal for China versus for the US and versus for Europe. A lot of bulk commodities are on the Chinese strategic list, which shouldn't be surprising because they import more than 50% of all traded copper, nickel, iron ore, it's even more, and met coal in terms of seaboard traded is also pretty much, I mean, everything, more than 50% of everything goes to China. So clearly you want to ensure that you have access to natural resources, and with significant foreign reserves, you can probably play a game where you outbid. And if you look at, we analyze this constantly, if you look at Nefsan, for instance, most major disposals that happened from Rio Tinto over the last couple of years, or Anglo American, or BHP, they all went to Chinese bidders and throughout the cycle. Yeah, so there is obviously a view of different risk profile, and possibly also, I mean, it's not always the risk, it's also the top line. The Chinese have probably a more bullish outlook on commodity prices than Western investors. Probably a stronger belief in their own economy.
Well, and also, frankly, look, I think it's natural. If you're looking at the whole value chain, if you as a, let's say, Chinese government are looking at the whole value chain, you might say, well, on this part of the value chain in terms of raw materials, I'm willing to live with a lower margin because, you know, what I'm looking is the whole value chain, and that's fine. I need to see how the value chain that ultimately works, but you know, if I have to pay more here, that's fine because I'll make the margin here. I think Western companies are just needing each individual part of the value chain to work on its own merits, and I think that's much more complicated.
I would look at it at the very, very top level. There's a huge amount of wealth in the country. And if you look at the big projects that they've launched, you know, Belt and Road, encompassing, you know, how many countries across the sort of Central Asia and Asia, and the internationalization of the RMB, the whole purpose of it is just to get this international investment internationally. So I would almost look at it as a big overarching mandate where they're less micro-focused, more macro-focused. And then they have big funds which invest, you know, for example, in African countries, state-owned. With institutional investors, for example, in Europe, you will find that it's private money, right? So it's managed, it's insurance, it's pension money. They have, individuals, and that's why they have to be their approach to risk is very different. So from our perspective, it's the more of a macro approach that the country has, and they have capital controls as well. For example, for the capital markets in Shanghai. In Shanghai, it's a very much locally focused. They have a huge amount of huge volumes. They're fastest growing capital market in the world. So what we've, for example, doing as an exchange, we are launching by the end of the year the London Shanghai Stock Connect, where we are basically enabling LSE listed companies to trade in Shanghai and Chinese companies to list and raise capital in London, and that has been never done before.
Yeah, I think the other thing also to bear in mind is a lot of the risks that people are taking in making investments are long horizon risks, and often some of the negative sides that haven't really come to fruition yet. So, for instance, Stephen talked about colonization of African countries. Well, I think European governments know that that's not about risk, they're disposed of their colonies in Africa. I think what you're seeing is that some Chinese companies have been spectacularly unsuccessful on a short-term basis, and when you take these big macro views on things, you're looking into long-term horizons. And so I think Western countries are quite justified with a long experience of long-term risk, of being circumspect, whereas with the recent growth in wealth in China, maybe some of these investments have been taken with less experience in evaluating those long-term risks than we would like.
I think, going to Ingo's point as well, we've obviously seen when China's gone big on a country, they've tended to, make a countrywide strategic investment. You've seen it recently with Serbia. We've seen it with a number of African countries in the past, so they can make a decision strategic about their relationship with that country. Whereas, private sector investors are usually looking at it on an asset-by-asset basis. That's the big distinction, I think, when it comes to countries that they can build those relationships with. Okay, a couple more questions from the audience.
Hello, good afternoon. I think I should say something here because I just do my speech on the Silk Road mining in China, in Beijing. And I'm from Beijing. Our company has some mines in China and also in this area, Central Asia. I like a CEO of the CA Minerals, the project which is located in Tajikistan in the Pamir. Also, we are looking for the investor. Why I'm here? Because I'm looking for a job. I'm not kidding. I'm very serious. I have a question. The question is how do you see this area for do some investment in the mining sector? Maybe my question is so clear.
In relation to that region specifically?
Yeah. In the situation, how do you think do the investment in this area and which problems we have to pay big attention here for you as your aspect? Because we are Chinese. We look at this area just like our neighbors.
Yeah.
But from Europe, I don't know how.
Yeah.
How you see?
So perhaps how are people distinguishing the risks and challenges of investments in this region compared to other regions?
I think
we've covered that a little bit. But is there any examples that you can give that were very particular to projects in this region, challenges that you had to overcome that you've not seen elsewhere?
I think let me just take the first shot. I think one of the main challenges is in looking at mining is actually looking at the resource estimates. And when one looks at North America or Canada or South America, generally you're looking at compliant resources under the format JORC or NI 43101. And in the former Soviet Union, you're looking at a different methodology of coming up with resource, and sometimes just looking at the analysis, I find that somewhat of a challenge.
I would probably approach it different and simply look at immediately solutions. One thing that we saw is quite helpful, and Kazakh Miss is a good example where instead of simply going it all alone, try to find a partner in the region. It's probably it doesn't make things easier because there's still then the selection of the partner is not an easy task in itself, but there is quite a lot of examples where actually joint ventures and partnerships, especially with local companies, can work well. And for instance, the solutions that Kazakh Miss or then Kaz Minerals did for building their recent mines, Portugal and so on, in Kazakhstan were beneficial to both sides. And I guess it works probably better because you have quite sophisticated counterparties in Central Asia than, for instance, in most African nations where you can also partner, but it's more likely international companies. So you're basically just sharing risk, you're not reducing it overall.
I think another slight difference, depends on the country, but there is probably a higher percentage or weight of state intervention enterprises in the mining sector across the Central Asia region, if you compare it to Latin America, for example, or even Africa. So that's sort of one distinguishing sort of feature. I mean, there's privatizations going on obviously in Kazakhstan, and that's all positive. I think the other point about the local partners, quite frankly, for us, as I've seen, many multilaterals, it's been difficult to find the right local partner, and that's been a particular challenge. Is finding a right local partner from a KYC perspective and all those aspects. So that's a particular challenge in this region.
I would only say that actually not all the countries within Central Asia are alike. They're all different, right? So different sometimes political situations, different state of economy. So Kazakhstan is very different from Mongolia, and we have Mongolian participants today, and Mongolia is also planning its own privatization. They have a very different political economic setup. They have in terms of mining, they have one of the largest coal assets, for example. And there is very little to do with other natural resources, for example. Uzbekistan as well, very different, and Tajikistan. So I would say it's important to remember that and to sort of assess it on a country by country basis as well.
Okay, we've probably got time for one or two quick questions. Anyone else from the audience? Yes, E.G. on the back row.
For companies operating in South Asia, I've seen them raising funds just before dry season. So I don't know how the climate is for the Central Asian region, but from banks and from investors, have you observed any seasonal or cyclical fundraising for the companies operating within that region?
I'll start actually.
Yeah.
I think from the heyday of the huge amounts of capital raised, especially by juniors in the mining sector, I think that day has passed. I think it declined over time, but I think now it's recovering, and it has a lot to do with the cyclical nature of the sector. Some of the segments are more interesting to investors at the moment than the others. Precious metals, for example, are very interesting. The uranium obviously is very interesting. It's now everyone's talking about the uranium bull market. What we're seeing is that from the London Stock Exchange perspective is that even sort of smaller junior companies from the mining industry coming to list, they are typically at a later stage of development than say 5 to 6 years ago. So they would very often they would already start production. They would already have revenues. So I think the approach by public investors to looking at these companies has changed. So we hope to see, bigger flow in the years to come, but I think it's still going to be pretty selective.
I'm not sure, was your question also about seasonality within a year in terms of weather, sort of windows and all the rest? Yeah. Yeah, no, so that's definitely an issue, particularly in certain areas and mountainous areas in Tajikistan, or, again, that just increases, particularly for juniors, the operational risk in terms of have they managed mines in this type of climate. What are the contingencies? What happens if they miss a weather window, etc. So it just compounds to the risk, the operational risk in the region. Having said that, you've got weather windows in many other places. In Africa, you've got wet seasons, where if a certain type of mining you can't operate in. So it's not completely unique, but yes, that's definitely a factor in terms of the technical risks.
I can just say that from a bank perspective, with all respect to our colleagues that are bankers, they move so slowly that they'll be busy for several wet seasons, never mind one. So there's no seasonality in debt farming.
Getting rushed along, I've got one last question for the panel. We talked a lot about Central Asia, and obviously the theme of MINEX generally has been the broader Eastern Europe, Central Europe, Balkans region. If I was to ask each one of you to name perhaps one country in that broader region, so across Eurasia as a whole, where you're seeing increased levels of interest, you perhaps personally have a significant amount of deals on the go, or optimism of deal flow that perhaps we haven't seen as much in the last few years. Would you just like to give your views on that?
Just from myself and my investors, I would say the most exciting region is the Balkans. And for several reasons, liberalization of those economies, some of them are within the European Union or adjacent to it. Some of them adopted the euro. Essentially there's a view that a lot of the polymetallic mines that run from Serbia into Romania and Bulgaria are highly interesting, including Macedonia. So I would say, for a whole host of reasons, in terms of the country risk, logistics, private equity view, the pricing of capital, the involvement of Western European banks to provide senior debt, and quite honestly, good management teams. So I think all those things together give me a great hope for the Balkan region.
My pick in this case would be Mongolia. I think that the reason there is that, first of all, the internal reforms have been effective. You can clearly see this in positive outlook economically, but also structural reforms. The IMF program is effective. I think they have the right set of commodities in the country, and it's close to the most important market. So we see, and this is really backed up by evidence. We have seen major copper companies, and not just the ones that are already there, really very actively scouting out and taking land positions. And I guess these companies usually, as the biggest ones, don't do this lightly. I mean, they have a very thorough process initially before they start opening up exploration offices again. So no one picks some land package without thinking how this organization can look like in 5 or 6 years' time.
So we already have a very big exposure in Mongolia, so I'll go with the Balkans. And no, seriously, I think for all the reasons Stephen said, it's where we're probably the most active in terms of looking at things right now. So.
As you know, we're very active in Kazakhstan. To us, it's a number one priority. Another number one priority is Mongolia. And we have been actually working with the Mongolian capital market since 2011. We actually helped build the Mongolian Stock Exchange. And then I would say Uzbekistan, because the IFC did a soon-denominated bond. And I think there are a lot of things to come out of Uzbekistan. The sort of Eastern European, South European, probably less in the mining sector, but we're looking at things there as well.
Okay. All right, thank you, everyone. Can I just thank the panel for joining us today?